Fears of a global slowdown fueling the biggest rally in Treasuries since 2009. How long can this continue?
I think that if you look at other parts of the world, Treasuries are actually still attractive. If you go over to Europe and look at Spain and Italy, they were trading at 2 to 2.3%. Then you look at the UK, which is below the United States. France is about 1 1/8% for the 10-year. And Germany is 75, 76 basis points. And then Japan is 50 basis points. So
that's crazy, right?
It is. Well, it is. But for investors,
for Germany anyway.
As an investment, it's more of tail risk insurance. That's what people are buying Treasuries for, and they're working. Treasuries have actually been phenomenally...
Does this tell you that deflation could be on the horizon?
Absolutely.
It's certainly in the realm of possibilities today, yes.
Deflation is in Europe. The Eurozone is certainly struggling with that. The ECB is inept on what they're trying to do in regard to ginning up inflation there. But what we're suggesting is that perhaps you don't want to be in the sovereign debt market overseas, and that's extremely bubblicious. Being that we can go anywhere, equities would be the place to be over the next 12 to 24 months. We believe that you can get pretty darn good return there of 7 to 8%. But, you know, look, the economy in the United States is doing very well, okay? The Eurozone is not. We're really struggling there, as well as the emerging markets are decelerating their growth. But earnings, which is really the driver, and economic growth in the United States, which is really the driver of the equity markets here, will continue to move forward, as you were suggesting.
Well, let me just note the 10-year note just finished down basically 4 basis points from where it was yesterday. So we had a wild ride, but it wasn't that bad. And to put all this in perspective, the S&P 500, to see a day as bad as this one, you have to go all the way back to Monday. Monday, the drop in the S&P was twice what it was today on the close. Well, as a matter of fact, Friday was worse. Thursday was worse. Wednesday was worse.
I mean, we rallied back, but I think just the volatility that we saw was pretty extraordinary. We have not seen such wild gyrations in the market like this.
Well, 2011.
In quite some time. 2011 is that to get a 460
when the S&P got
drop.
downgraded in the United States, that's when we had the volatility like this.
Every time the Federal Reserve pares back their liquidity program, you get this volatility. The Federal Reserve has applied a sedative to the market with the QE. They're paring that back. They've signaled that they will raise rates.
And we've known that.
Yes, but we knew that the last several times as well. And the markets have went into this fit.
You got to go through it. It's like you go to the dentist, he numbs you, right? When the Novocaine wears off, it hurts, but you don't keep going back and you don't keep getting more Novocaine. That's what we've been doing. Sooner or later, you just got to get over the toothache and you'll feel fine the next day.
That is so well put.